Hey guys, Brian Stevens here with the National Real Estate Post. I have Chris Martin once again. You all know him as the co-CEO over at Oaktree, our great NonQM partners in the industry here to help you guys out. Got a whole bunch of stuff going on that you need to know about as a loan officer to kind of navigate some of the turbulent waters that are in front of us right now. So the first thing I want to talk to you about, Chris, here is let's just jump right into this, man. I just heard of a loan officer who closed like 6 or 8 refinances. And he says, I'm surviving on purchases. I'm thriving on refinances. I saw the NBA came out and said that mortgage availability actually went up and down based on refinance volume. And everyone's going, who in the heck is doing refis? I had a conversation with you where you said about 50% of your business is refis. So tell me what products you guys are using right now that loan officers are finding success with refinances.
Obviously, cash out is big. You know, if we can allow somebody to leverage the equity that, you know, even according to the Fed yesterday, if you read the numbers and all the housing data that came out, you know, the home purchase prices haven't dropped. They're still increasing. So that means what that means is that there's untapped equity. What you and I talked about the other day was the consumer debt has gone up exponentially. So people have debt, they need to pay it off, they need to refinance it, they need to figure out a way to manage it. Their incomes haven't gone up. People are either they're underemployed or they're self-employed, they're struggling, whatever their deal is. They are in a position that they need to consolidate debt. Christmas is coming. They want to get things in line for the new year. They want to make sure they have access to the cash they need. So cash out refi is the way to go. Obviously second mortgages as well. But listen, I used to tell clients all the time, you know, and it wasn't a 3% rate that we were comparing it to, but it was more like a 4 or 5% rate. But, you know, when your bills are at 24 and 28% and you can't afford your next meal because you just wrote your last check for your last credit card payment, you know, how much is that 3% rate actually costing you? What is it that's doing for you right now? How is that helping you achieve your goals? So if you find a client that it's all about what's appropriate for the customer. Not every customer is going to be ready to refinance their loan. Not every customer is going to be there. But if you find the ones that need your assistance, they're out there, they need your help, and they don't know where to turn to.
So is this what you guys are seeing? Again, an extraordinary amount of your volume is from refinances. Are these the stories that you're hearing from your AEs?
Absolutely.
Taking place?
Yep. First of all, if they can't move, what's the other thing that they want to do, right? They want to improve their house. So there's those cash out refinances that we're doing a lot of. There's the cash out refinances that we're doing because they need to pay off debt. They're drowning in debt. They need to pay it off. When the money was coming in, it was good. They were like, "Oh, this is great, all this free money," and then they realized, "Wait, I got to pay for this at some point." So they need to lower their expenses. Maybe they're getting cut overtime at work. Maybe they're getting less bonuses at work. Whatever the case might be, there's not as much opportunity for them to earn income, so that they need to reduce their expenses. What's a great way to reduce your expenses? Well, eliminate the debt. Get rid of the credit card debt. They've got $100,000 sitting in equity. Why don't you tap into some of that and pay off your credit card debt?
You know, we kind of have this, call up the National Guards because the Fed's Jerome Powell said a couple of naughty things yesterday that has a lot of the mortgage industry spinning out of control right now. And we spoke about this a little bit, but I said, well, hold on a second here. With that record $1 trillion in revolving debt that we have right now, and the Fed's making it more expensive, more painful for consumers on a month-by-month basis, I mean, some of those people are invariably going to be turning towards cash out refinances as a solution to what they're doing. I know that you said, well, maybe they're going to file bankruptcy on it, but that's not the solution for everybody.
Let's face it, guys. I mean, if you're making more than, I can't remember, insert the number here later, but if you're making more than, it's like $110,000, you can't even file a Chapter 7. You have to file a Chapter 13. And then you're going to rely on a bankruptcy trustee to determine what is your disposable income for the next however many years, 5 years that you're in that plan. And that means that every single nickel that you have that doesn't go towards housing, food, and your other secured bills goes right to creditors. That means you don't have any free income. So a bankruptcy is not really your option. So either you probably don't qualify for it because you can't do a Chapter 7. And you have to be, by the way, you also have to have zero money in the bank to file a Chapter 7. Or you're going to do a Chapter 13 bankruptcy, in which case somebody else is going to tell you how you're going to manage your expenses for the next 5 years of your life. Or you could do a refinance and maintain your freedom, right? Or and figure out a way to get out of debt. And if at the end of the day is that you still can't afford it, then you can always sell your house. But you have equity at this point, so you have options.
I really hope loan officers kind of heard what you said there, because if you find yourself in this conversation, and if you're not finding yourself in this conversation, then you're not you don't have an outreach program that's good enough right now, because there's a ton of people, record numbers of people who are in this exact situation that we're talking about. And what Chris just gave you was a rebuttal to any questions that they might have about a bankruptcy. And it's not to persuade them to do something that they shouldn't do. What you're hearing here is most people probably can do this. And in the event they do go down that road, they might find the terms so difficult that a cash out debt consolidation refinance would be a better option on the table for you. Some of the programs that you have, I mean, let's just call this for what it is. We're looking at non-QM, so rates are going to be slightly higher than agency stuff. But you also have, go ahead.
Sometimes.
Sometimes. Okay, great. Let's talk about that.
Yeah, we just acquired a loan from somebody else. We bought a loan from somebody. They were planning on selling it to like a JP Morgan, Chase Bank type jumbo outlet, and we priced it better on one of our non-QM loans.
And that's something.
Made more sense to do it non-QM. It was easier to qualify. They didn't have to worry about debt ratio issues, all that kind of stuff. We just came right over. So I mean, and the rate was the same, I think. So yeah.
Okay, so loan officers, right now, I want you to consider this. You can go ahead and price one of your loans with Oaktree. Take you just a couple of seconds to do, just to see where that rate and that product stands with what you've got in front of your clients right now. There might be a better option in front of them. What's that site that they go to, Chris?
NonQMexpert.com.
Okay, so you go to nonqmexpert.com. You can get a quick quote based on the file that you have in front of you. See if you can beat it. I mean, why wouldn't you, especially if it only takes a couple of seconds? That's really interesting to hear. So if we think non-QM is always going to be a high rate, that's not the case.
And even if it's a higher rate, it's not always the highest payment, because we can always go 40-year term. We can do a 40-year fixed term, or we can do interest only with a 40-year AM. So they have 10 years interest only and then amortizing the 30 years. And by the way, you saw the Fed dot plot yesterday, right? Mortgage rates are going to go down in 2 years. So you got a customer today, you got a customer tomorrow, you got a customer in 2 years from now too. So I mean, as you know, that's a great way to build that book of business so that you can continue to add to your client base.
I had a conversation with one of my good friends, the loan officer, Shannon Hoff, and she was talking about her files that she's doing today. And she's like, yes, for every loan that I'm writing today, it's going to be 2 or 3 loans down the road. And she's right. She's absolutely right. The Mortgage Bankers Association, Barry, all the prognosticators out there are telling you that rates are going to come down. And even if they don't come down the next 6 months, 12 months, they're going to come back down again. And when you do, you've got another deal in front of you, right?
It's so funny. From 2001, right, until last year. I mean, that's how long? That's 21 years. You heard rates are going to go up at some point. Rates are going to go up at some point, and then once rates finally go up, rates are going to come down at some point. It's the same. Yeah. At some point they'll come down. I don't know when. Listen, if inflation stays embedded at 4% for the next 5 years, they're not coming down for 5 years. I don't have to tell you.
Chris, no joke. When we started this whole thing out with Think Big, Work Small, I kept saying, I forget if it was up or down. I said rates are going to go up, and I said it on the show. I said, listen, I'm going to stick to my guns on this. Inevitably, I'll be right. It took me 8 years, but I was right eventually.
You guys had a thing that I used to use because I've been running secondary for a long time, and I ran sales and secondary at one of the companies I was at. And you had a thing that said, there's a 33% chance that rates are going to go up. There's a 33% chance that rates are going to go down. And there's a 33% chance that rates are going to stay the same. So you're 2/3 of the way there. If you just want to go, you should go ahead and lock now, because there's only a 30% chance the rates are going to get any better than they are right now. So.
I'll tell you what, and if you go to Vegas, your odds are better in Vegas, and you're going to lose there. So lock your loans now.
Right.
Hey, let's talk about this too, because I know a lot of loan officers have a number of different pain points, and it still surprises me that more LOs aren't really looking deeper at non-QM and the opportunities in front of them. But tell me about a couple of areas of success that your AEs are finding with their loan officers. I just had a conversation with one of your AEs, he just did 10 million in volume in a month.
That's not
extraordinary amount of volume.
That's not one AE, by the way. We have a couple AEs that are 10. We have a couple of them that are 8, 9. So they're closing loans.
And what they're doing is they're having conversations with their loan officers, and they're actually working with strategies that are bringing deals in the front door. Yep. That's what you guys need to really understand here. It's not just quoting the product. It's what is a strategy that's making money move. And this is what Oaktree is going to do with you guys. But what are some of the products and strategies that people are using?
Well, what I was going to tell you is as a loan officer, and I've been a loan officer, and most of my staff has been in your shoes. It's all about you have to become the expert in your field. You've got to be the one that knows. My first boss in the mortgage business always made the analogy that you had to have it was like you're a Western cowboy, and you got your 6-shooter, which is your sales skill, but then you got bullets all along your belt. Remember all the old bullets they put along your belt? And every time you added something new to your knowledge base, every time that you added something new to the new product or new understanding or new offering, that was just another bullet that you had on your belt, so that anytime that you had a new customer, you had another solution that you could solve. If you're an expert in something, what that doesn't mean is that, hey, I'm a loan officer, I passed the test, I'm the expert in the mortgage business. That's where it starts. right? Where you get to be 10 years into your career as a loan officer, or 20 years into your career as a loan officer, is when you understand this is the scenario, this is where it needs to go, this is what needs to happen, and this is where I can do it. And you can do that with pretty much anybody that walks in your door. Obviously, you're going to be able to very quickly discern what a turn down is and what it isn't. But look, you're going to have that strategy in place. So what are you doing? Are you working with financial advisors?
Yeah.
Are you working with real estate agents to refinance their book of investors? Are you working with their real estate agents to find out who their investors are and who needs to buy more investment properties as things become available on the market? Because what's on the market right now is probably more distressed properties. Are you teamed up with somebody that can help you get a rehab loan? Then you could help do a fixed product so they can stay in it and then rent it out, because they might not want to sell it right now because property values are still increasing. And then if property values are increasing and interest rates are up, well, what's going to happen when rates come down? They're going to just continue to increase. So,
yep.
I mean, and that's a segment of the market that's become problematic and why inflation's remained embedded, but it's just a percentage of it. So that doesn't mean that has to go down simultaneously. So, and then the other option is that you have to call your existing client base, the people who you did loans for when you refinanced them at 3%. If they've taken on any debt and they really don't, and they're not in a position to touch that 3% rate, we do seconds. We've been doing a lot of second mortgages. We've really started to see a lot of increase in the second mortgage product. So and by the way, if you close your loan at 3.5-4% with a bank statement loan, we can do a bank statement second, and we can do that up to 85% loan to value, giving you all cash out. If you're full doc, we only need 1 year of income, right? 1 year of income, 90% LTV, all cash out. So you can do a 90% CLTV deal, all cash out. If you don't know how to calculate blended rate, call one of my EEs. They'll walk you through the process on how to calculate blended rate. Because I can tell you that, the rate's going to be high on that second, but when you factor it in, what's the first mortgage rate? What's the second mortgage rate? What's it blend out to as a percentage of what the overall total outstanding debt is? You're going to look at a payment that's much, much lower, and you're going to look at a rate that's much, much lower than what you get even refinancing it today. But not everybody qualifies for that. So the ones that don't, do the whole money refinance, right? Or that's not, whatever, that may not work for them. They might be too big of a loan size. It might be whatever reasons holding them back. We have those options for them as well. We're doing both.
Yeah, and you know what, loan officers, you need to be proactive, not reactive. With what Chris is talking about, don't wait for the conversation to come to you. Take the conversation to your past client database.
They already heard it on the radio. They already heard it. They got the flyer in the mail. They heard it on the radio. They got the telemarketing. They got the unsolicited spam call they accidentally picked up on their cell phone. But you got to call them. You're the one whose number pops up in their caller ID. Send them a text message. Hey, I was just thinking about you. What do you? How's it going? How's your finances? How's life treating you? And then get into that conversation. Talk about their financial well-being, talk about their financial health. You have notes, hopefully. If you use a CRM, you can go back and see, what did you guys discuss? What did you guys talk about back when it was easy money, right? Now it's more hard money. How do you get out there and how do you get in front of the customers and reinitiate those conversations? Hopefully you've been sending birthday cards and stuff like that, but got to talk to people. Got to keep in front of people.
Not reactive, proactive. Don't be the target, be the arrow. Does that make sense? And have these conversations with your realtors. What investors have you worked with in the past? Are any of your clients, your past clients, are they aspiring investors? When you have conversations, they have these things called black swans. Black swans are unforeseeable events that take place outside of what your purview or your knowledge set is. Okay, so you go into a conversation and you don't know what's going to take place until that conversation actually takes place. You can and will, for instance, have somebody who says, I just ran into an inheritance. It happens all the time. Or again, a black swan, an unforeseeable event. In that case, you could then have the very logical and proactive conversation of, have you thought about investing in real estate? Have you thought about or looked at DSCR loans? You could actually take a past client and turn them into an investor. And what we were just talking about a moment ago before we started this, Chris, was DSCR loans. And you brought up a great point. You said, well, investors aren't time sensitive when they're going to buy.
Yep.
Like a lot of folks right now don't want to uproot their kids from school. They just started. Investors don't care about that. So let's talk about just real quickly the advantages of programs like DSCR and why this is a great opportunity for investors, loan officers, and realtors to team up.
Well, first of all, you made a great point. We're talking about equity. You've talked about people. Yeah, I mean, how many conversations have you had with a borrower that said, "Man, I'd love to invest in I'd love to own a real." You're going over the 1003 and you're asking them about the real estate own schedule, right? Because everybody takes a good, solid, thorough 1003. As you're going over the real estate own schedule, you're saying, "Hey, do you own any other properties?" And how many of the borrowers did you talk to that said, "Man, I wish I owned more properties. I'd love to have that free cash flow income." Okay, great. Now's a great time to contact those people because they have equity, so you can help them tap the equity in their subject property. You could take that equity and then you could go buy a new investment property. And they might not qualify with their, they won't have to go through all the taxes and everything else. That's fine. If you're going to take that money, you're going to tap the equity, you're going to go after help them buy their first investment property. You put that money down, you can qualify with the debt service coverage ratio, because all you got to do is make sure that the payment, at least, or that the rent on the property either meets or exceeds the payment on the mortgage. And we can do that interest only. We can do that 40-year term. We can do that on an ARM. It doesn't matter. And it's based off what the payment is today. So you're going to be able to help your potential borrower buy their first investment property. And you're probably going to help your realtor out as well, because you're going to give them that referral. Hey, I got a borrower that wants to buy an investment property. We went online, I found a property on blah, blah, blah. Here, take them to it, show it to them, and go close the deal for them. That's we talk about those strategies all the time. We talk about it with fourplexes and all that kind of stuff. And guys, people aren't doing it. People just aren't doing it.
Chris, honestly, I'm not kidding you. I just had an aha moment here. So I just said, well, you never know. You might call somebody and they ran into an inheritance. You just don't know. What you just made me think of, you brought up equity. Every one of your clients has run into an inheritance in the form of equity. Every call you have has the inheritance that I spoke about. It's in the form of tappable equity in their house. They all have it. So when you have these phone calls, you can go into the phone call, shorten the distance between you and actually making that call. Think of this. Every one of your past clients has an inheritance in the form of equity that they can go ahead and tap into and become investors. Almost every one of them. Think about that. Now imagine a world where you and your realtor get together, find a property that pencils. You can do it. Find a property that pencils, see what your LTV needs to be, and then call your and that realtor's database up and say, hey, listen, you've got $200,000 in tappable equity. Would you like to purchase a property and increase your real estate holdings? Everybody has the potential to buy that house because they've got equity right now. Now, when you're making that call to your past client, you're calling them with an opportunity. You're calling them with a simple proposition.
I want to put money.
Would you like to increase your real estate holdings?
Yep.
And the answer is going to be yes. Every one of your clients that you close 2 or 3 years removed from that purchase, they've got it. Yep. That's a brilliant strategy. That the whole equity play, it is an inheritance.
Yep, absolutely. So, that we're doing a lot of, like I mentioned before, we're doing a lot of DSCR loans. And as we look towards, we always look at this business as cyclical, right? We tend to see the big slowdown happen somewhere after October, sometime after Halloween. People start getting focused on Thanksgiving and Christmas and the end of the year and their parties and their family and their celebrations. Well, who isn't thinking about that? Property investors. Yep. They're opportunistic. If they see a property that pencils, like to your point, if their realtor called them and said, I found a property that pencils, they're going to say, hey, I'll buy it. It's what's sign and do a couple of DocuSign, click signs on a DocuSign and wire your money into title. They're in escrow, right? And then they're going to do a DSCR loan. They show a couple of months to show they've got some assets, and then the deal's done. If you've already done the loan for them, you already know what their credit score is. You know about what it is. I mean, short of them changing here and there, you pull their credit, you send it in, it's a done deal. Those people are going to continue to buy houses, and they're going to be buying houses through January and through February and all year long. So the more investors that you have, most investors that we see, they don't stop with one. They start with one. They stop with 100. And then if you have investors like that, we have solutions for those folks too. We can do blanket loans. We can help them buy up to 8 unit properties, and that number is always growing. And so we've got lots of opportunities where we can help you. So we can help you tap the equity in the form of a cash out refi. We can help you tap the equity in the form of a second mortgage. We can help you finance the new investment property in the form of a DSCR loan. We can help you, cover a bunch of those properties with a blanket DSCR loan. We could be your one-stop shop. No pun intended, to help you get investors and bring them to market, and then also manage the current investors that you already have.
Hey, Chris, love having you on. This is all great information for loan officers. I just want to say this, or keep doing what you're doing, and how's that working out for you? Honestly, I'm not trying to be condescending about it, but we need to broaden our horizons, put more bullets in that belt type of thing here. And here's the really cool thing, and I need to stress this to you guys. The AEs over at Oaktree, they're waiting for you right now. They're there. They will help you learn the language of NonQM, and they will help you with your marketing prowess to go ahead and make this a reality for your business right now. You can get by with your purchases as you have it right now, but you can thrive with your refis and your investors. Does that make sense? You can thrive with it. It's just a call. It doesn't cost you anything. It's a little time, a little intellect, and it potentially could be a huge upside in these difficult times. Then we don't have to worry about what Pal says. My God, I'm sick of it. Chris, thank you so much for everything once again, and I look forward to our next time.
Thank you, Brian. Appreciate the time.